In this video, we're going to talk about why you should not invest in cryptocurrency, and instead invest in the stock market. Investing is a crucial aspect of financial planning, and individuals have an array of options to choose from. Among the popular choices are stocks and cryptocurrencies. While both offer the potential for substantial returns, this essay aims to highlight why investing in stocks can be considered more secure than investing in cryptocurrencies. We will explore key factors such as regulation, market stability, intrinsic value, and historical performance. 1. Regulation and oversight. Regulation and oversight play a vital role in determining the security and stability of investment options. When comparing stocks and cryptocurrencies, there is a notable difference in the level of regulation and oversight they are subject to. Stocks, being part of traditional financial markets, operate within well-established regulatory frameworks. Government agencies such as the Securities and Exchange Commission (SEC) in the United States, the Financial Conduct Authority (FCA) in the United Kingdom, and similar bodies around the world impose rules and regulations to protect investors and maintain market integrity. These regulations govern various aspects, including financial reporting, disclosure requirements, insider trading prevention, and market manipulation safeguards. Such oversight provides a level of assurance to investors that there are mechanisms in place to monitor and regulate the activities of companies and market participants. In contrast, the cryptocurrency market operates in a relatively less regulated environment. While some countries have introduced regulations specific to cryptocurrencies, the level of oversight varies significantly across jurisdictions. Cryptocurrencies, being decentralized and often based on blockchain technology, pose unique challenges for regulators. The absence of a centralized authority governing the entire market makes it difficult to implement consistent regulations globally. Consequently, investors in cryptocurrencies face a higher degree of uncertainty and potential risks due to the lack of robust regulatory frameworks. The lack of regulation and oversight in the cryptocurrency space also leaves it susceptible to fraudulent activities and scams. Instances of hacking, theft, and fraudulent initial coin offerings (ICOs) have occurred, resulting in substantial losses for investors. The absence of regulatory scrutiny can create an environment where unscrupulous actors take advantage of unsuspecting individuals. In contrast, the regulated nature of the stock market, with its compliance requirements and investor protection measures, helps mitigate such risks and enhances the overall security of investments. Furthermore, the presence of regulation in the stock market fosters transparency and accountability. Publicly traded companies are required to provide financial reports and disclose material information to investors regularly. These reports undergo rigorous scrutiny and auditing, ensuring that investors have access to accurate and reliable information to make informed investment decisions. In the cryptocurrency market, however, there is often a lack of standardized reporting and disclosure requirements, making it challenging for investors to evaluate the financial health and credibility of cryptocurrency projects. In conclusion, the disparity in regulation and oversight between stocks and cryptocurrencies significantly impacts the security and stability of these investment options. The well-established regulatory frameworks governing the stock market provide investors with a higher level of confidence, transparency, and protection. In contrast, the relatively unregulated nature of the cryptocurrency market exposes investors to greater risks, including fraud, hacking, and price manipulation. As the cryptocurrency market continues to evolve, regulatory efforts are underway in many jurisdictions to address these concerns and provide a more secure environment for investors. If you're liking this video so far, let us know by pressing the like button. And to see more videos like this, be sure to subscribe. 2. Market stability. Market stability is a crucial aspect to consider when comparing investments in stocks and cryptocurrencies. The level of stability in each market can significantly impact an investor's risk tolerance and the potential for long-term returns. Stock markets, which have been in existence for centuries, have a long history and operate within established structures. They are influenced by a wide range of economic factors, company performance, and investor sentiment. While stock prices can experience volatility in the short term due to market fluctuations, news events, or economic conditions, They generally exhibit resilience and tend to recover from downturns over time. The presence of institutional investors, market makers, and regulatory oversight contributes to market stability by providing liquidity and mitigating extreme price movements. As a result, stock market investments are often considered to have a higher level of stability compared to the relatively young and volatile cryptocurrency market. On the other hand, the cryptocurrency market is characterized by its nascent nature and high volatility. Cryptocurrencies are digital assets that are not tied to any specific government or central authority. The absence of a centralized governance structure and the relative ease of market entry make the cryptocurrency market more susceptible to rapid price fluctuations. Prices of cryptocurrencies can be influenced by various factors, including market sentiment, technological advancements, regulatory developments, and media coverage. While this volatility can create opportunities for substantial short-term gains, it also exposes investors to higher levels of risk and uncertainty. Moreover, the cryptocurrency market is still evolving, and its valuation is primarily driven by speculation and demand-supply dynamics rather than fundamental factors such as company performance or earnings. This speculative nature can amplify price swings and contribute to a lack of stability in the market. Investors in cryptocurrencies need to be prepared for significant price fluctuations and understand that the potential for higher returns is often accompanied by increased risk. In contrast, the stock market is influenced by a wider range of factors, including company financials, economic indicators, industry trends, and investor sentiment. The valuation of stocks is often based on fundamental analysis, taking into account the financial health, earnings potential, and competitive position of the companies. This fundamental analysis provides a more stable foundation for stock market investments and allows investors to make informed decisions based on a company's intrinsic value. In conclusion, the stock market generally offers a higher level of stability compared to the cryptocurrency market. The established structures, institutional participation, and regulatory oversight in stock markets contribute to market stability and resilience. On the other hand, the cryptocurrency market's nascent nature, high volatility, and speculative nature make it a more volatile and uncertain investment option. It's important for investors to carefully assess their risk tolerance and investment goals when considering investments in either stocks or cryptocurrencies. 3. Intrinsic value and tangible assets. Intrinsic value and tangible assets are key factors to consider when comparing the investment potential of stocks and cryptocurrencies. The presence of underlying assets and the ability to evaluate intrinsic value provide investors with a sense of security and a basis for assessing long-term prospects. Stocks represent ownership stakes in companies that have tangible assets, products, and services. When investing in stocks, investors have the opportunity to analyze a company's financial health, profitability, market position, and other fundamental factors. This fundamental analysis allows investors to assess the intrinsic value of the company and make informed investment decisions. Tangible assets such as real estate, manufacturing plants, inventory, and intellectual property contribute to a company's value and provide a measure of security. Additionally, the ability of companies to generate consistent revenue and profits over time enhances the intrinsic value of stocks. On the other hand, cryptocurrencies lack tangible assets or cash flows that can be used to evaluate their intrinsic value. Cryptocurrencies derive their value primarily from speculation, demand-supply dynamics, and technological developments. The value of cryptocurrencies is driven by market sentiment and investor perception rather than underlying assets or financial performance. While some cryptocurrencies are associated with blockchain projects or decentralized applications, the direct link between the value of a cryptocurrency and the underlying project or technology is often less tangible than the assets associated with stocks. The absence of tangible assets and the reliance on speculation in the cryptocurrency market make investments in cryptocurrencies inherently more speculative and risky. The prices of cryptocurrencies can be influenced by various factors, including market sentiment, regulatory developments, media coverage, and technological advancements. This volatility can lead to rapid price fluctuations and a lack of stability in the cryptocurrency market. In contrast, stocks are backed by the tangible assets, operations, and revenue-generating capabilities of the companies they represent. Investors can evaluate a company's financial statements, industry position, competitive advantages, and growth potential to assess its intrinsic value. The existence of underlying assets and the ability to conduct thorough fundamental analysis provide a level of security and transparency for stock investments. It is important to note that the valuation of both stocks and cryptocurrencies is subject to market dynamics and investor sentiment. Both asset classes carry risks, and their performance can be influenced by a variety of factors. However, the presence of tangible assets and the ability to evaluate intrinsic value provide stocks with a more solid foundation and a greater sense of security compared to cryptocurrencies. In conclusion, stocks offer the advantage of being backed by tangible assets and the ability to assess intrinsic value based on fundamental analysis. The presence of these factors provides investors with a greater sense of security and a basis for evaluating long-term investment potential. Cryptocurrencies, on the other hand, lack tangible assets and rely on speculative factors for valuation, making them inherently more speculative and prone to market sentiment. Investors should carefully consider their risk tolerance and investment goals when deciding between stocks and cryptocurrencies. 4. Historical performance and track record. Historical performance and track record are important considerations when comparing the investment potential of stocks and cryptocurrencies. Examining the past performance of these asset classes provides insights into their stability, growth potential, and risk profiles. Stocks have a long history of delivering positive returns over the long term. Various studies and analyses have demonstrated that diversified stock portfolios tend to outperform other investment classes, such as bonds or cash, over extended periods. Historical data can be analyzed to identify trends, patterns, and the overall performance of different sectors and companies. Investors can draw upon this information to make informed decisions based on the track record of specific stocks and the broader stock market. The historical performance of stocks helps establish a level of confidence in their ability to generate wealth and preserve value over time. In contrast, cryptocurrencies are relatively new investment instruments with limited historical data available for analysis. The first cryptocurrency, Bitcoin, was introduced in 2009, and the market has since expanded with the introduction of numerous altcoins. Due to the nascent nature of cryptocurrencies, their historical performance spans only a relatively short timeframe. While some individuals have experienced significant gains in the cryptocurrency market, there have also been instances of extreme volatility and substantial losses. The lack of an extensive track record makes it challenging to assess the long-term performance and stability of cryptocurrencies. The historical performance of stocks is often supported by economic trends, company performance, and market fundamentals. Stocks represent ownership in established companies with a track record of revenue generation, profitability, and market presence. The valuation of stocks is influenced by various factors, including financial health, earnings growth, and dividends. Historical data on corporate finances and market trends can provide insights into the stability and growth potential of stocks. Cryptocurrencies, on the other hand, are driven by a different set of factors, such as technological advancements, market adoption, and investor sentiment. The historical performance of cryptocurrencies is characterized by significant price fluctuations and periods of rapid growth or decline. It is essential to recognize that the past performance of cryptocurrencies may not necessarily be indicative of future performance due to the unique dynamics and speculative nature of the market. In conclusion, stocks have a long-established track record of delivering positive returns over the long term, supported by economic trends, company performance, and market fundamentals. The historical performance of stocks provides investors with insights into their stability, growth potential, and risk profiles. Cryptocurrencies, on the other hand, have a relatively short history, marked by significant volatility and a limited track record. While some individuals have achieved substantial gains, the speculative nature of cryptocurrencies and the lack of historical data make it more challenging to assess their long-term performance and stability. It is crucial for investors to consider their risk tolerance and investment goals and conduct thorough research when evaluating the historical performance of stocks and cryptocurrencies. In conclusion, while both stock investing and cryptocurrency investing carry risks, investing in stocks can be considered more secure due to factors such as regulation, market stability, intrinsic value, and historical performance. The presence of regulatory oversight, market stability driven by established structures, tangible assets, and a track record of long-term positive returns contribute to the overall security of stock investments. It is essential for investors to thoroughly evaluate their risk tolerance and investment goals and conduct due diligence before making any investment decisions, irrespective of the asset class they choose to invest in.